Today we're looking at four S&P 500 charts. Let's get into it. First, 5-week winning streaks. As you may have seen, the S&P just barely logged a gain last week, up 2 basis points. And that was thanks to the comeback on Friday after that big negative reversal bearish engulfing pattern on Thursday, which saw the S&P lose 1.6% intraday. So it was enough to produce a 5-week winning streak for the second time in 2024. That means we've had two of them happen within the first 5 months of the year. And all that, of course, followed the 9-week winning streak to really conclude 2023. You look back in the last few years, this is different for a few reasons. Number one, 2021, we know, was a very consistent uptrend coming back from the COVID explosion higher. And so within it, only one time did a winning streak extend to 5. Also, there were many more winning streaks along the way. And so we had a higher frequency of winning streaks, but they just weren't that long. That just means we had intermittent pullbacks along the way, much more than we've had so far right now, which has been more or less one-way market aside from the 4-week pullback in April. 2022, no surprises, just a handful of them, and the longest one was 4 in a row, and that was within that very strong bear market rally in the summer there. And in 2023, only had one extend beyond 3 up until the low rally from October 2023 to where we are right now. So it just means that this has been different and stronger in many ways. Now we see it in terms of weekly winning streaks. And so you shouldn't ignore the fact that we could get a downturn some point again. And one way to detect that is looking at the MACD indicator. Now, we talked about this one before, and this is going to be very interesting to see how it plays out, regardless of what happens. Because in 2022, really just using MACD sell signals gave us a very good idea of when the market was going to turn lower after those bear market rallies. And it even worked very well in February of last year, right? Right after the top at that point. So a downturn was totaled just about 9% from high to low. But what's happened since then? We've had 10 more sell signals for the MACD, but only 2 of them have worked out. And both of those times, they occurred after having 4 come and go, just providing whipsaws within extended uptrends. And we know when these occurred from last fall, and also from the spring and summer of last year. And really, these were the best and strongest runs that the market has seen since 2021. So as of right now, we don't have a sell signal just yet, but as we can see, the lines here within the MACD are starting to curl over just a bit as momentum is starting to fade. And so we're going to, number one, see if when one occurs. Number two, how the follow through works this time. Because if we do see a sell signal that works out, that will be 2 in a row for the first time since 2022. So that would show us that there is some sort of character change that we have to at least respect. And so why is this going on? So one of the reasons that if you look at the S&P 500 stocks versus the moving averages, they're at a lower part or lower point now compared to the highs in March. So what is this showing us? A negative divergence, right? Lower highs versus higher highs for the S&P 500. Now you compare that to what happened or what we were at back in March, where at the peak of the S&P itself was also the peak of the number of stocks trading above their long-term moving averages. Weren't quite there regards to the 50 and 20, but very close to where they were before. And now this looks like a change. And, we know the reasons why this is occurring, just there are things underneath the surface that aren't doing as well as the S&P 500 itself. So the real reason is that if we look at the S&P 500 and the RSP Equal Wgt ETF, this is what you get. This is the relative line, RSP divided by S&P 500, making a new multi-year low. And actually, we can pull this all the way back to the 2009, and is making its lowest point since that year. And so what does it tell us? It tells us that large cap tech has been leading really since the beginning of 2023. And we acknowledge the fact that it's not always like this. We'll recall from the middle of 2020 all the way through 2022, large cap tech underperformed. And that was during a market rally and also during a bear market, where it hasn't been the case recently. And it's not like the market hasn't tried. We've highlighted here the areas at times when RSP at least did as well as the S&P 500, and times when it outperformed. Each one of them, though, up to this point, is proven to be just short-term respites within a longer-term downtrend. And so recall too, this was recently when in April, the market was rolling over. We know technology was doing poorly, especially toward the end, as the big cap tech names started to report, and some of them didn't do as well. And we know the S&P was down 6 straight days in April, but toward the end of that, we started to see positive breath result. And so that just means that the field, if you will, was doing better than the S&P 500, better than large cap tech, and that was helping the S&P stay afloat at the time. So that just means that at some point, technology is going to lose its bid again. And if the market is going to maintain its bid, it'll be up to the rest of the sectors to do a better job and hold up the S&P once more. That's it for today. Talk to you again soon. Check out these videos and subscribe. Thank you.